Hi. Let's learn about the 83(b) election and how it impacts taxes on restricted stock grants. The 83 election is a provision under the Internal Revenue Code that gives an employee or startup founder the option to pay taxes on the total fair market value of restricted stock at the time of granting. The 83 election applies to equity that is subject to vesting, alerting the IRS to tax the elector for the ownership at the time of granting, rather than at the time of stock vesting. For example, a co-founder of a company is granted 1 million shares subject to vesting and valued at $0.001 at the time of granting. At this time, the shares are worth the par value of $0.001 x number of shares, or $1,000, which the co-founder pays. If the total value of the company's equity increases, the co-founder's tax liability for each year will also rise in accordance. The 83 election gives the co-founder the option to pay taxes on the equity upfront before the vesting period starts, allowing the co-founder to only pay taxes on the fair market value of the shares, minus the cost of exercising the options. The election also allows for taxation of capital gains if the shares are sold for a profit. An 83 election is beneficial only if the restricted stock's value increases in the subsequent years. It might also be beneficial if the amount of income reported is small at the time of granting. The 83 election would be detrimental if the equity value falls or the company files for bankruptcy, leading to an overpayment in taxes for shares with a lesser or worthless amount. Profits interest refers to an equity right based on the future value of a partnership awarded to an individual for their service to the partnership. This type of worker compensation requires an 83 election. The 83 election allows someone to pay taxes on their stock awards at the time that they are granted, rather than at the time of vesting. It is particularly beneficial to startup employees, allowing them to reduce their tax burden in the long term. Here are 3 key takeaways. 1. The 83(b) election is a provision under the Internal Revenue Code, IRC, that gives an employee, or startup founder, the option to pay taxes on the total fair market value of restricted stock at the time of granting. 2. The 83(b) election applies to equity that is subject to vesting. 3. The 83(b) election alerts the Internal Revenue Service, IRS, to tax the elector for the ownership at the time of granting, rather than at the time of stock vesting. Hope this would help. Thanks for watching.